Ramsey. Credit Suisse expects Canada to have 50% more millionaires by 2021. The number of Canadian millionaires is expected to grow by 50% over the next 5 years, according to the latest edition of the annual Credit Suisse Wealth Report. Credit Suisse said Canada currently is 1,117,000 adults with asset holdings exceeding $1 million, an increase of 25,000 individuals from last year. Based on forecasts in the growth of Canada's gross domestic product and equity market capitalization, Credit Suisse expects the number of adult Canadians whose wealth exceeds $1 million will rise by 50% to 1,680,000 in 2021. Canada is a rich country by global standards. According to Credit Suisse, Canada has about 4% of the richest 1%. Even though Canada makes up only 0.6% of the world's adult population. Canada is a rich country by global standards. According to Credit Suisse, Canada has about 4% of the richest 1%. Even though Canada makes up only 0.6% of the world's adult population. Credit Suisse said wealth per adult in Canada lags the U.S. by about 22%. The average Canadian adult has about $270,000 in assets, while the average American holds $344,000. Yet Canada's wealth is better distributed, with Canada's median wealth per adult, $96,700, more than double than in the U.S., where it's $45,000. Canada also has a smaller percentage of adults whose wealth is beneath $10,000 and a larger percentage of adults with more than $100,000. Credit Suisse says wealth per adult in Canada has grown an average of 5.9% a year since 2000 when measured in U.S. currency, or 4.9% a year when measured in loonies. The Canadian economy is heavily weighted to resources and has suffered from the dip in prices for oil and other commodities. Yet Credit Suisse says Canadian wealth has still managed to rise because low interest rates continue to fuel housing prices in major urban cities. Globally, Credit Suisse says aggregate wealth increased by $3.5 trillion or 1.7% to $255.7 trillion. The bank said the increase merely kept pace with global population growth, and wealth per adult of $52,819 was unchanged for the first time since 2008. The United Kingdom posted a notable slide in wealth in the aftermath of the June Brexit vote. Wealth per adult decreased $30,000 to $289,000. The CRA is cracking down on real estate tax dodgers in Canada's red-hot market. Evidence of the ongoing crackdown by the tax authorities on Canada's red-hot residential real estate sector is everywhere, from recently updated statistics that show increased real estate audit activities, to new rules governing the sale and reporting of your principal residence and even some recent tax cases. Earlier this year, the Canada Revenue Agency indicated that transactions in the Greater Toronto Area have been the subject of greater scrutiny, including audits, for some years and that, more recently, the CRA has been actively monitoring and auditing real estate transactions in British Columbia. The CRA is focused on a number of areas of compliance risk in the real estate sector, which include questionable sources of funds, property flipping, unreported GST/HST on the sale of new or substantially renovated properties, the new housing rebate and unreported capital gains. Since April 2015 to the end of September 2016, The CRA indicated that in Ontario it has completed the audit of 13,403 files, resulting in a recovery of $210.4 million. In BC, during the same period, the CRA audited 2,366 files, resulting in $30.3 million in recovered tax. The CRA also charges a penalty equal to 50% of the additional tax payable if a taxpayer knowingly makes a false statement when filing the return. During this period of increased audit activity, the CRA applied 663 penalties, totaling $12.5 million, with the highest single penalty being nearly $2.5 million. Last month, in an effort to gather data about the dispositions of principal residences, the CRA reversed its long-standing published administrative policy that said you did not have to report the sale of your principal residence on your tax return if you were eligible for the principal residence exemption. Starting this year, the CRA said that it will only allow the PRE if you report the sale and designation of principal residence on Schedule 3, capital gains of your return. The CRA is also pursuing, and winning, tax cases against individuals involved in real estate transactions. Take, for example, the most recent case, decided earlier this month, involving the GST/HST new housing rebate, which allows an individual to recover some of the GST or the federal part of the HST paid for a new or substantially renovated house. One of the main conditions to be eligible for the new housing rebate is that you must buy or build the house for use as your or your relative's primary place of residence. In addition, if the intention at the outset is to flip the property, you won't be eligible for the rebate. The recent case involved an Ontario couple that attempted to claim an HST new housing rebate for a house they purchased in Milton. The purchase agreement was dated in October 2011 for a price of about $425,000. The purchase of the house closed on April 10, 2013, and it was immediately listed for resale on April 21, 2013 for $517,000 as a brand new never-lived-in home. The house sold shortly thereafter for about $510,000. The CRA denied the couple's claim on the basis that the couple never lived in the home when they bought it, nor did they ever intend to, based on the location of the house relative to where they then lived and worked and relative to where they later bought a different type and size and value of house into which they did move. Black Friday Deals 2016, the best bargains in Canada and where to get them, with the loonie still weighing in below 75 US cents, and more Canadian retailers embracing America's biggest shopping day of the year. Many shoppers who traditionally head south for Black Friday will be staying home this year. How to shop Black Friday, Canadian style. Canadians now spend 25% more on Black Friday than Boxing Day, but many of them never enter the store. Holly Shaw looks at the biggest shopping blowout of the year, Canada style. Read on as to that possible disruptions at Canada's second busiest commercial border crossing at the Blue Water Bridge near Sarnia because of a strike, and Canadians have even more reason to stay home. Here's a roundup of the deals you can find in Canada on Black Friday and even before that, and remember to check back often, because we will be updating the deals from now until Cyber Monday. Remember, the early bird gets the best bargain, so check here to find the Black Friday hours of malls across Canada. Bank of Canada rate cut is more likely than markets think, economists warn. Toronto, the market is too complacent about the prospect of further interest rate cuts from the Bank of Canada, some economists say, as an uncertain outlook for the NAFTA trade accord risks derailing an expected pick-up in Canada's business spending. The central bank expected in October that growth in business investment will turn positive in 2017 after disappointing in recent years. But Donald Trump's surprise U.S. presidential election win has triggered uncertainty about the outlook for the North American Free Trade Agreement, which economists say will discourage investment. Even if trade isn't disrupted from Canada, the uncertainty over our trade position with the U.S. will, if anything, delay the turn in capital spending, said Nick Exarchos, economist at CIBC Capital Market, who sees Trump's stance on trade damping Canada's growth outlook. Rising uncertainty surrounding the trade position has not translated into increased expectations for the Bank of Canada to lower interest rates despite it having considered a cut last month before holding its policy rate steady at 0.50%. It last cut in July 2015. The market does not expect any change in rates through mid-2017. Overnight index swaps data shows a 30% chance of a cut was implied before the U.S. election on November 8. Part of the shift in expectations is mechanical as the increased chances of hikes by the Federal Reserve interest rate help push Canada's rates higher. We have seen markets price in a bit more tightening from the Federal into next year, which tends to have some sort of a pass-through into Canadian rates. But Canada's fundamentals have not materially improved, said Andrew Kelvin, senior rates strategist at TD Securities. He estimates a 40% probability of another Bank of Canada rate cut during the current easing cycle. To be sure, Canada may get a boost from proposed stimulus spending in the U.S., Canada's largest trading partner. We might get some spillover effects, but I don't think it would necessarily be enough to overcome some of the uncertainty or anxieties about U.S. trade policy, said David Wood, chief economist at HSBC Bank Canada. The recent spike in bond yields may also weigh on Canada's economy. That means tighter financial conditions here in Canada, including the housing market, which was already subject to tougher macroprudential regulations, said Jimmy Jean, senior economist at Desjardins.